Hyatt Commercials. We connect people, businesses, and real estate. Join us now for a coffee talk where we talk to industry leaders about trends affecting CRE.
I have Steven Hyatt with me today. Steven is if you recognize the name, obviously Steven's grandfather, Lou Hyatt, founded Hyatt Commercial, the company that I am now the president of. Steven and I have gone back many years doing deals together, and in line with the family tree, Steven is an entrepreneur at heart with a foundation in as an attorney and as a real estate guy. And I'll let Steven introduce himself now, but he comes today with a little bit different perspective on the market. So Steven, why don't you go ahead and introduce yourself?
Sure. Thanks, Justin. It's fun to be doing this with you and hearing Lou's name. You know, he's 96, and seeing what he started 60-some years ago, how it's evolved into what you're running today, it's pretty exciting. It's awesome to see. Congrats to you and the team for all your success. My background, you know, I guess, like you said, it's in my blood, banking and real estate. And I do have, it wasn't like I was thrust into it and it's a Stockholm syndrome type thing. I like it. I appreciate it. I enjoy it. And, you know, you get to see the fruits of your labor, like the real tangible effect of bringing a tenant to a shopping center or developing some land. Like, I don't know, you shape the community. It's fun. You're kind of the driving force to progress and growth and job creation, and it's kind of behind the scenes, and I like all of that. You know, it's you're the even though the NIMBY community typically says we're evildoers, I think generally speaking, a good bunch, good mentality.
No, I completely agree with you, and I think, you know, one of the fun things, you know, you coming from a, you know, long, you know, family history in real estate, and obviously the name is on the business still. You know, I look at it as, you know, part of my job is to be a good steward of that name, and that, you know, certainly the Hyatt name, but also the Mullen name, which, you know, we're long standing in the area as well. And so being able to do that in real estate really has a unique, you know, opportunity where you're helping other businesses really grow.
Yep. Yeah. And same thing with banking, right? Like, you know, you're providing a growth vehicle or sustainability mechanism for small businesses. That's the name of the game. And there's a lot of big business out there, but I feel like small business doesn't quite get the attention it necessarily deserves. There's plenty of groups out there that talk about it, but actually making small business the focus of what you do, and I feel like Hyatt Commercial, ACRE, and whatever, all these community organizations do a good job at that. And yeah, so timeline, I think we both started at the bottom, the great financial crisis, you know, beginning of our career. And my thought at that point, you didn't really know it was the bottom, but it felt bad. And, you know, we thought,
I was having this
can only go up from here.
I was having this discussion earlier this week, and I actually remember the exact day I started in commercial real estate. It was January 8th of 2008. And when I was hired, I was told that 2007 was like the best year the industry had ever experienced. And about 90 days later, after I started, you know, I wouldn't be in this industry. You know, the world really did fall off a cliff, and I was, you know, I don't attribute a lot of things in life to luck, but certainly timing, you know, can be lucky, and it was for me.
Yeah, no, timing certainly plays a big part in it. Not, you know, I didn't know, I don't think anybody did, but I generally was of the mentality that it can't get much worse, and maybe it could have, but my thought was, all right, if you can make it through this, learn a lot, then it's really uphill or downhill from here. It's just so much easier. So that was kind of the starting point. And I really, that was me in brokerage at Hyatt Commercial, but also working at what was Severance Savings Bank as a relationship officer, and then back to Hyatt Commercial. Transitioned over to law school and the legal world while running Hyatt Commercial, and then made the full leap into the legal world it's been like 8 or 9 years now. Gosh, is that how long you've been at ACRE?
Yeah, I think 2017 was when I stepped in the shoes.
That makes sense, because I think I took the bar in 2016. So yeah. So, I've really seen deals from, I don't want to say just both sides, but all angles, from the lender side, borrower side, legal side, representing both borrowers and lenders, developers on the entitlement side, landlords and tenants on leases, buyers and sellers on contracts. I've kind of seen it all. Done some foreclosure work and workouts. Like, I've seen it all, and that's kind of the genesis of the thought process to ACRE. And it was end of 22, early 23. I was having a conversation with Alan and a couple others, and I said, there's no lending going on, and rates were high. I said, let's start another bank, and that was quickly shot down, and I was told that's a terrible idea, and the cost of compliance and all the regulations, don't waste your time. So that turned into, logically, I was like, all right, well, how can we actually lend? And it's private lending. It's bridge money, and that's the pretty short origin story for ACRE.
Let me kind of dig in there. So, and again, just getting back to your history, there's not a lot of people that have the kind of breadth of experience that you have, and having kind of grown up simultaneously in multiple different sectors of real estate over the last 15 plus years, and it makes perfect sense that you saw an opportunity in the market to get into alternative capital, private debt, but because that's a growing portion of the market, give us a little bit more detail of what that means. ACRE Capital being an alternative financing structure. Explain a little bit in more detail about what that actually is.
Yeah, so private lending, essentially, it's alternative capital, bridge lending, private credit, whatever you want to call it, however you label it. I guess the best way to think of it is it's banking without the BS, right? It's the same concept. You need to borrow money to get a deal done, and you're going to provide some collateral, and the lender's going to figure out what the risk level is and make you a loan. That's what it is at a high level. Way more flexible than traditional financing. It moves much quicker and can be pretty flexible, and I guess offers a broader range of optionality, I would say. And this isn't new. I mean, nothing novel here that I've come up with. A lot of big names in the space: BlackRock, CBRE, Walker and Dunlop, Arbor, they all offer this. And then on the opposite end of the spectrum, a lot of small hard money lenders doing $50,000 fix and flip loans. But there really aren't that many mid-sized lenders in the space where ACRE wants to play. And that's the one to call it $10 million loan size. It's a little too big for the small private fix and flip folks, and not quite big enough for the institutional funds. And it's a perfect fit for us because it's relationship lending, right? It's what my background is. It's what Severn Bank used to be, what community banks used to be back in the day, and some capabilities. I mean, obviously we're going through underwriting and doing our due diligence, but it really is at the core, our focus is relationship lending.
And so what kind of makes that unique for you in particular is, obviously with your background, you've got the capability to understand kind of the full life cycle of a real estate investment or an investment, really, for that matter. From the front end, legal, entitlement, development side of it, to the middle there where, you're having to provide the capital, and then the back end where, whether it's being sold or leased or, utilized for some, for a business, you've kind of lived that whole life cycle. And I agree, it's not a new funding model, but, it seems like it really has been at either end of the spectrum over the years. Your local cost, hard money lender, and then corporate level, institutional level lender that, is probably doing it based on relationships with a corporate institutional borrower. And you guys kind of fit right in the middle where, you've got the ability to, without some of the constraints of a traditional bank, lend on projects that you understand. Right. And that, okay, I can sit down and not just look at it as one single point in time, but look at the whole life cycle and make an evaluation on it.
Yep. Yeah, that's exactly right. And I think it seems like this is becoming more commonplace. I'm seeing more and more bridge money or private credit in the capital stack or early on in deal structure. Even if banks aren't lending, deals are still going to get done. They might pencil out differently, but I think that there's the experienced and qualified operators always find a way. And I think with M&A and things like that, private lending is going to become more and more prevalent.
Yeah, and with that in mind, kind of going from your history and what you're trying to do, now, what are the deals that you're targeting? Like, where are you finding success in being able to lend money right now?
High level, before me specifically, generally folks are looking at bridge money when they have a non-income producing asset or an asset that isn't quite stabilized yet, or traditional financing. For example, a bank says you got to be at a 1-to-5 debt service coverage ratio, and it's at a 0.9, and it's going to require some lease up for maybe 6 to 12 months. I would hold that paper for the bridge term, the short term between stabilization or to stabilization, and then they can go to a traditional lender and refi, take me out at conventional terms, longer term financing. So like unique assets, so marinas, hospitality assets, land. For me in particular, land in Maryland is something I'm not afraid of because I know I can navigate that legal process pretty easily or have the resources to do it. Traditional lender falls through at the finish line, or if you just have to move quick. Like I've closed loans as fast as like 7-10 days from first call and term sheet to the closing table. Like we move quick on $1.5 million, $3 million loans. So in that same vein, those types of borrowers, those situations, I'm generally looking at asset class agnostic for the most part, especially in Maryland, which is where most of my loans are. In the $1 to $10 million range, I want the borrower to have good experience and strong background, realistic and achievable exit strategy, whether it's a sale at stabilization or refi stabilization or whatever the case may be. Usually 70% loan to value, and they got to have some skin in the game. Got to be a meaningful participation because again, it's a partnership, a relationship. Terms are usually 12 to 24 months. I can extend that out on a deal by deal basis with 3 to 6 month extensions up to about 36 months. And these are all interest only loans. So it kind of helps. Yes, the rates are above bank debt and below hard money, a couple in the 11-12% range. But when it's all IO, it usually doesn't pencil out to be that much more. You're just not building up the equity you would with a traditional lender. But it's short term,
creating that equity through some value add.
Exactly.
In theory, that's why they need the money, right?
Precisely. Yep.
Right.
You got it. So, usually a couple points, point or two at origination, and then these are senior loans for the most part. limited exceptions for doing something mezz or junior, but mostly senior loans and full recourse. And my borrowers are happy. My investors are happy. My borrowers are happy, and deals are getting done. They're good assets, and I think it's just going to keep growing. And I'm hopeful that I can continue to scale it. Been having some conversations recently with some other groups doing something similar. The idea being there are some larger loans that we're getting calls on in the warehouse industrial space, retail space. Let's say anywhere from 15 to 25 million. It's a little much for ACRE on its own, a little too much, but through a participation agreement, we can make that work. And I've got a couple groups that are eager to do that.
With that being said, I think Maryland and really the entire kind of mid-Atlantic area, because of the, major cities that, we're kind of all, tertiary markets of, or the cities themselves, it has been not a ton of volatility, and not, it's not like one asset class, explodes and takes off. It's pretty stabilized. But is there anything in particular right now you're seeing, kind of geographically or asset type that you see an opportunity that that your borrowers are coming and saying, I'm probably a little bit ahead of the curve, but here's what we're doing. Anything in particular that catches your attention right now?
Ahead of the curve, I wouldn't label it as that. I feel like there's still space in the industrial warehouse sector. There's some big players in it, and in the right location, there's still room. I think in the 95, DMV corridor, give or take, 30 to 50 mile radius, there's a lot of opportunity there.
And kind of just to dive into that one a little bit, part of probably why you are a good fit for that kind of lending is a lot of assemblage is required now to achieve the bulk that's needed to do that kind of development. And that may require multiple settlements or acquisitions to get that done. I mean, is that somewhere you're finding some success?
Yep, absolutely. One of the Hyatt commercial brokers kind of worked on, one of my borrowers put together with the help of your team. I think it's like 19 or 20 small parcels to get collectively around 8 acres for, what's going to be 150,000 square foot warehouse facility near the airport. I mean, it's a home run site, but banks are looking at that like, what the hell am I doing with 19 individual parcels?
Right.
But it's zoned right. The engineering isn't that big of a deal to consolidate the lots, and it's just a matter of taking it through the motions. And so, I love the asset. I love the location. Borrower has a very strong track record and background and capabilities, has the right engineering team, right partners. I mean, that's a perfect example. And same thing on the retail side or multifamily side or townhouse side, talking with a group now, doing the exact same thing, right? Like they found, I think there's 7 parcels to get around 12 acres for some townhouses. On their own, not much value, but together, talking about 100 or so townhouses, that'll get the attention of a regional or national builder, and they just need the time and capital to create the value. And those are assets or loans I'll probably make for the right borrower all day.
Yeah, that's that middle market, kind of forward-thinking developer mindset that you have, where you can look at it and go, all right, we can understand this collectively and know what our downside risk is if the entire business plan isn't executed on.
Yep.
Yeah.
Yep. And then also, I've got some money out with small multifamily assets where there's some rent increase or expansion opportunities. And I mean, in this market, multifamily is very strong. And I think there's been some, and I think you'll continue to see it, the baby boomers getting out of their assets, trying to sail off into the sunset, don't want the hassle of managing something they've held forever or an asset that's been held by several generations. And so now, the $10,000 a month income is getting split up 7 ways because folks want the payday and want to move on. So I'm seeing a lot more of that recently, and they're good assets. I think even just a little operational efficiency, there's value to be had.
Any thoughts on the banking world and kind of lending strategies going forward? I mean, obviously what you're doing is filling a gap, but just in financing in general, any kind of additional thoughts on that?
Yeah, I mean, look, I like a lot of bankers. I think they are just hamstrung by regulations, compliance, and the cost of funds, right? Like, I don't need deposits to make a loan. Most of them do. And I think that with the cost of compliance and funds going up, operational efficiencies going down, there's going to be more M&A over the years. There aren't that many community regional banks left. I don't know the exact number, but in the 80s there was like 40 or 50,000 of them. I think it's probably down to 3 or 4,000, maybe less. And they're just going to keep getting consolidated and fewer. So more private lending. And then when that happens, they're just going to lend to the cream of the cream.
Yeah.
You're going to have to be a AAA credit borrower, blemish free, and have the best, risk-free asset for them to lend to you. So I think there's going to be more and more opportunity for private debt. But I mean, all that to say, they're going to be on the back end, right? Like, they're going to be sitting there eagerly awaiting these stabilized assets that I'm lending on. Once it's all cleaned up, I can put a little bow on a package and say, here you go. I handle the risk for you. And that's just, everybody's kind of in their lane, and it's a service not going away. But I think getting there is going to require more debt like ACRE.
Yeah. And I know, one of the things that our clients really like about, community banks or, private lender like yourself is like, pick up the phone and just talk to somebody.
Right.
Not having to go through multiple layers of approvals and, not being certain that the message or the business plan or the financials are being communicated properly, and having somebody else on the other end of that line who understands it and can think creatively. That's a big deal. To that middle market is the entrepreneurial world. That's where people are creating value because they're willing to take a little risk, because they're intelligent and have a great business plan.
Yep. And I mean, there's a lot of institutional money around here, and in the larger town centers, big industrial parks, office parks, but for the most part, a lot of owner-occupied small businesses, and that's really who, or investors, that's really who ACRE is focused on. I maybe should have said this at the beginning, but the name ACRE itself, it went through a lot of iterations to come up with something, catchy, clever, whatever you want to call it. It stands for Alternative Commercial Real Estate Capital. And I just think that you mentioned early on, you gotta be flexible, and having an alternative solution that still gets a deal done. That's the name of the game, right? Like, I can be creative and flexible, and I can move quick and get a deal done. It's really up to the borrower. They're organized, have everything they need, and I can move quick. And I want to put my investors' money to work and see deals get done, see vacant land or properties redeveloped. Like, I like that. It's fun to see those communities get reshaped and have a hand in that, like I said at the beginning here. So,
well, I think that's a great message to end on. Unless you've got anything else that you want to share, I think You've given us a lot of good insight into the business and kind of where you're headed.
Yeah, I appreciate it. I'm always happy to look at an asset, even if it's not something I'd lend on, give you my feedback on it from any one of my perspectives or wearing any one of my hats. But thank you. I appreciate it. Look forward to catching up with everybody in person soon.
Yeah, exactly. This podcast is followed up by a coffee talk where Steven will come in and speak to our whole team about his products and services, and looking forward to having you.
Great. Thanks, Justin.
All right, man.
Hyatt Commercials. We connect people, businesses, and real estate.